so some of the questions that I wanted to answer in the DeFi section this morning and deliver you guys some value. Let's go into the chat. The first one being, I'm not going to butcher this individual's name, but they asked, what do you guys think about some of these 1000% pair returns? All right. And so in the DeFi education section, you guys have this PDF, which is labeled Understanding Your Risk Tolerance in DeFi. So we're going to go over this, and I'm going to try to talk to you guys about diversification. I'm actually going to pull up another little picture real quick. We're going to talk about diversification. I'm going to talk about what percentages you should have in high risk plays, low risk plays, medium risk plays, depending on your capital, how much you're starting out with, and so on and so forth, and just give you guys a little bit of a perspective as to where you should be allocating your capital towards, and if taking those high risk plays are even, worth it. All right, let's open this as well. And then the second question that we're going to go over is this one right here. And this is going to be a really good breakdown. I just actually created this PDF for you all this morning. I was meaning to, but this question actually led me to just doing it for you guys this morning. So the second question that we're going to cover is from Kozak. Hopefully I'm pronouncing the name correctly. So if we find a good AMM with great returns, and if they dump $10,000 into it, will I break it? Is the idea to find heaps of smaller AMMs and drop smaller amounts of liquidity into them? And so I'm going to kind of go over this question as to what we should be looking for when entering into a liquidity pool, and the criteria that myself and Mr. Aquaman look for when we're entering into a liquidity pool, and just kind of show you guys some examples and go through some walkthroughs. And you can use this information when going through and looking for liquidity pools yourself on any DEX. Okay. So let's talk about the first question first, which is, what do you guys think about some of these 1000% return pairs? All right. Well, let's first understand our risk tolerance as investors. Each person, that's going to change from person to person. So are you more risk averse? Are you more risk on? A risk adverse person has a lot more to lose, right? You don't have a lot of capital. You're more worried about the capital that you are implementing into this space. Maybe it's because you don't have a high income right now. Maybe it's because you're a little bit skeptical about DeFi, or maybe it's because you're really attached to the money that you are investing with, right? You're more risk adverse. You don't really want to take on a lot of risk. Whereas somebody who's more risk on, like myself, I have an excess amount of income, right? Not only through trading, but I have like 5 other sources of income that are making me money. And so for me to put $1,000 or $2,000 into DeFi, I don't really care about that money if it goes to zero. So I'm more risk on, right? And so you have to kind of assess where you are at in your life, whether you are more risk on or risk off. That's first. Once you assess that risk profile, right, then ask yourself the question, how comfortable are you with market fluctuations? Do you get anxious even with the slightest fluctuation in your investment and your value? Do you have an emotional attachment? Can you stomach seeing your portfolio? For example, my case, at the peak in 2024, my crypto portfolio was worth over $260,000. Now it's worth like $206,000. So that's over $50,000 depreciation. And I could care less, right? Right? Because I know the longevity of my portfolio is most likely going to be way higher in value. And so I can stomach the volume and the volatility to the downside in the short term, right? And so you have to be able to assess that risk on your own behalf, on your own accord. Can you stomach that? Are you okay with seeing that depreciation in your portfolio and understanding that that's only a most likely short-term setback? All right. Then establish what your investing goals are. Okay. Are you looking for steady, predictable returns? Or are you entering into the DeFi space with $50, $100, and you're looking to really scale quickly to then re-implement that capital back into blue chip plays that are more long-term, right? What are your goals? Are you starting out with $1,000 looking to scale that to $10,000 by the end of the year? Or are you a little bit more laid back and you have $10,000 already and you're just looking for a steady return on that? Again, what are your goals? You have to be able to determine that yourself. So once you've established number one, traverse to number two, and then number three, how much loss can you handle? Are you okay with the possibility of losing a portion or the entirety of your investment for the chance of higher returns? Understanding that these 1000 percentage plays that are flashed in front of you, and I'll just give you an example. 2 weeks ago, this pool, spam soy, the liquidity in the pool was a lot higher than it is today. The trading volume in the pool was a lot higher than it is today. And the APR was at like, I don't know, 1,200% or something crazy, right? And I mentioned to you guys that this is a very high risk play, that eventually these numbers will throttle down and people will see that it's just a meme coin. And if you're going to get in this play, get in, get your money, and get out, right? And so, how much are you willing to lose? A portion or possibly the entirety of your investment? Any money that you put into this pool is most likely worth a lot less now if you didn't get in and get out as quick as possible, right? So when you're playing these high risk plays, you really have to be careful, which is why we're going to get into the checklist. So that way, hopefully you guys avoid those plays and you are here for the long term. All right. So let's get into different risk strategies in DeFi. Okay. So once you've understood your risk tolerance, going through this checklist up here and asking yourself these questions, assessing your own personal risk, then you can tailor your DeFi investment strategy accordingly. So here are three different approaches. So for the more risk-averse investor, that's someone who does not want to take on a lot of risk, is looking to get into DeFi, but doesn't want to deal with the massive fluctuations, doesn't want to deal with the high-risk plays, and is just looking to get into DeFi, get their foot wet, and start earning passive income consistently. Okay? So I wrote, if you lean towards being more risk-averse, your priority is most likely the preservation of capital and minimizing volatility. In DeFi, this means sticking to safer options. And so some of those safer options would be stablecoin pairs or heavily correlated pairs with wide range liquidity pools. Okay. So keep that in mind. If you're risk adverse, meaning that you have $10,000 and you don't want to really lose any of that $10,000, you're going to be looking for stablecoin pairs. Why? Because stablecoin pairs mitigate impermanent loss, because the value of the assets which you're providing liquidity for don't go up and down in value. Presumably that USD Tether or USDC or any other stablecoin holds its dollar peg, right? Obviously, of course, there's that risk, but still, there's no volume and volatility to the up and down side in your investment. Okay. So if you plug $10,000 into a stablecoin pair, then you're just going to start earning APR or APY on said pair. You're not going to have to deal with impermanent loss factors. Okay. Then it comes down to correlated pairs, right? That's another example. So for this PDF, I plugged in wrapped ETH and Bitcoin, or Bitcoin and Ethereum. Reason being is because those pairs are heavily correlated. You can go to DeFi Llama, and if you scroll right down here, they have a correlation tool. It's new. You click it right here, and you can plug in different assets. You hit this little plus button right here, and you can plug in different assets, and you can see how correlated they are. The closer the number to 100, or 1, collectively speaking, the more heavily correlated they are. So you can see right here, Ethereum and Bitcoin on a yearly scale. So here are different time parameters at the top. You can choose yearly, monthly, or 7-day correlation. Well, on a yearly and annual basis, Bitcoin and Ethereum are 0.98% correlated. That is extremely correlated. That means if Bitcoin is going up in value, 9 times out of 10, Ethereum goes up in value, right? On a monthly scale, they're 0.61% correlated. So I'd say that that's still over 50% on a monthly basis. And on a 7-day scale, 0.84% correlated. So again, this just goes to show that Bitcoin and Ethereum are heavily correlated. So to mitigate impermanent loss or to mitigate price fluctuations via the assets that you're providing liquidity for, that is just, again, a way to mitigate risk if you are more risk adverse. You don't really want to take on a lot of risk. And you can choose different assets by clicking the plus button and comparing them, right? You have a whole list to choose from to go in and see the correlation. So that's another way that you can, again, mitigate your risk in this market if you're more risk adverse. Another way is to choose wide range liquidity pools and believe in the longevity of the asset for that wide range liquidity pool. For example, I used HBAR USDC. Reason being is because in this saucer swap V1 pool, you're not concentrating your range. That means you're providing liquidity for the entire range of this trading pair. And in my personal opinion, HBAR is going to be one of those long-term survivors in the digital asset space. So even if you did plug capital into this liquidity pool and HBAR depreciated in value, that means the value of HBAR from the time in which you put capital into this pair went down, the only way that you would experience impermanent loss is if you sold out of the position. But number one, because it's a wide range liquidity pool, you don't have to adjust your ranges. So you're still going to be earning the same APR without adjusting your ranges. And because you believe in the longevity of HBAR, that means during the next bull market cycle, you think it's going to increase in value comparatively to where you plugged in your capital at. Then there's no point in selling the position and experiencing impermanent loss because long term, you're holding this position with the expectation for it to go up in value, right? So those are three different ways as a more risk adverse person, you can create a strategy if you are less willing to lose the capital in which you're playing with. Get into stablecoin pairs, get into pairs that are heavily correlated, get into wide range liquidity pools where you don't concentrate the liquidity. You can do this on Aerodrome. You can do this on Saucer Swap. There's many other pools as well in DEXs that you can provide a wide range of liquidity for with assets, blue chips that you think are going to perform well in the future. All right. Then we have our moderate to medium risk investors. So what are some strategies you all can partake in? That's somebody who's a little bit more risk on, but still a little bit risky, a little bit skeptical, and doesn't really want to play with the money that they have, but they're more on the fence and the cusp of willing to lose, right? So this is medium. Well, I mentioned to you all that you have the option to invest in crypto stablecoin pairs, right? Pairs up against a USDC coin or USDT coin up against a crypto, which offer moderate risk returns in slightly higher APRs, right? Then you also have the option to concentrate your liquidity, where it becomes a little bit more risky because, again, you could possibly experience impermanent loss if the value of the digital asset from where you put the money in goes down in value. But obviously, of course, with more risk comes higher return. Because you're concentrating that liquidity, you get a higher APR than you would in these situations, right? So remember that the less risky you are, the less return you're going to get. That's something else you're going to need to keep in mind for your DeFi strategy. For me personally, I sit in the moderate risk investor section where the most of the liquidity pools that I'm in are giving me decent returns, but are paired up against an asset that is volatile, right? That means it goes up and down in value. It's not stable like a stable coin. Okay. So for concentrated ranges, right, you're going to need to understand technical analysis. You're going to need to understand fundamentals and the overall trend of the market, whether it's up or down. Reason being is because, for example, this week we saw a more risk on market sentiment. So if you were entering into a concentrated liquidity range, I would like somebody to answer this question, take advantage, take initiative. Where would you want to give your concentrated liquidity range this week more breathing room, to the up or downside? Somebody answer that question for me.
To the upside.
Good job. To the upside, right? Why? Because the market this week was more risk on, right? Investors are more likely inclined to buy risk assets this week. So you don't want your liquidity range to be tight to the upside. You want to give that more breathing room. To the downside is where you want to kind of pull up the bottom of your range, looking at concentrating it underneath of higher lows and giving your range more breathing room, above higher highs to the upside, right? So it is going to require you a little bit more elbow grease and understanding about the market. But again, you have the advantage of higher returns. And I just gave you guys some examples. You got the soy USDC pool, Sol USDC, concentrated range. And then on Saucer Swap, you have the USDC HBAR V2 pool option where you can go and concentrate the range, unlike the V1 option, right? And then last but not least, we have the high risk investor. So for me personally, again, this is just a personal example, not financial advice. If I was coming into DeFi and I only had $1,000 to start out with, I would be a high risk investor, looking at those meme coin plays, but playing it strategically, where each week or each day, I'm pulling profit off of those high risk plays with the $1,000 that I initially started in and immediately putting that into safer plays to secure that profit. So, just as an example, okay, for high risk investors with lower capital to start out with, or even if you have more capital to start out with and you're looking to scale that quick and you're willing to risk it, you're looking at those meme coin plays, right? The Shiba Inus, the Doges, the freaking cat coins, whatever. Okay. And I'll show you guys some of those examples. And Turbos was a great example where the past 2 weeks, spam was like freaking OD. Everybody was asking, dang, the 1,200% looks appetizing. And the liquidity was at like 500,000 and the 24-hour trading volume reached like 826,000 at one point, right? Well, if you're in that play, remember, high APR strategies, you're looking for higher returns in a very short period of time. But how do you survive that? You need to be strategic. Oh, look, here's an example. You see how high the APR was when I took this screenshot? 1,160%. Okay, here's another example. This freaking one was nuts. I found this one. 5,700% APR. What? Okay. And it was up against Kendu and Wrapped ETH. I don't know what meme coin that is. But if you're going to get into these plays, the strategy that I would partake in is I would pool daily. I would pool profit daily. Every single day that these pools made me money, I would take the profit from these high risk pools and I would plug them into pools like this, or even go look at compounding or yielding accounts like Compound or Aave and put the money into stablecoin pairs. So that way you're immediately de-risking, right? If you're going to get into these pools, have the mindset that they are going to be daily and weekly plays for you. They are not. I literally took this screenshot, by the way, like when I created this PDF, I think it was a week or two ago. And you can already see how the APR is throttled down. Okay. So if you're going to get into these pools, again, to answer this individual's question, it's okay. I know that there's going to be people that come into this space that only want to take these plays and only want to grow their money. Understand that you are taking on more risk. It really comes down to answering the first couple of questions. How risk adverse or risk on are you? Once you have that, then you can go in and start to create your DeFi strategy. And if you're going to enter into these pools, understand that crypto inherently within itself is already risk on. And so this is just increasing your risk. If you're looking to build a small portfolio, it's a good strategy if you're smart. If you're in these pools and out of these pools ASAP in a day. You make $50 in a day, boom. Take the $1,000 out of the pool because it's liquid. You don't have to keep the $1,000 in. Put the $1,000 in somewhere else and take that $50 off the table, just like a trade, right? Don't leave the money in the pool hoping that the next week it's going to do the same thing because you're going to get burnt. The market's going to catch up to you. The algo is going to get you and you're going to lose your capital. You're going to feel stupid. So don't hug on to these plays. Don't marry them. Just like in trading, we don't marry biases, right? We react. If you're going to react to these high percentage plays and you jump in and you start earning $100 a day, don't expect the same thing's going to happen next week. Okay. So just play your cards smart if you're going to get into these plays. Again, this is not financial advice, and I'm not telling you guys to go out there and do this. But again, we're going to have people in this community that only have $100, right? And that's fine. Because if you play your cards right, you can turn $100 in a month into $3,000 as long as you're in these plays, you're out of these plays, you're taking profit, and then you're plugging that capital into the lower risk plays, right? So just keep that in mind moving forward. So let's get into the nitty gritty of strategy. All right. So I typed this out for you guys. This is again based off of a total of 100%, splitting that 100% of your capital. So let's say you're starting out with $1,000, where I would allocate that money into. So for me personally, I would allocate 30% of that $1,000 into stablecoin pairs, focusing on stablecoin pairs or highly correlated pairs with a wide liquidity range. And I gave you guys some examples. So I would stick, what is that, 30%, $300, right? Of the 1,000 into stablecoin pairs or low risk plays. So that's $150. Again, if you're providing liquidity, you need an equal amount of both pairs. So 150 in USDT, 150 in USDC. Boom. There's your $300. There's your 30% allocation of your $1,000. Right? Then you have the medium risk. So I would stick 50% of that $1,000 into the medium risk plays. So then I'm earning a higher APR, but still again earning APR and taking a more risk on approach. Then I would stick 20% of that $1,000 into meme coin plays to try and scale that capital. So that's $200 playing around in high risk plays. So for example, right, looking at this position here, $200 in this pool in one day with the 5,700% APR, you're looking at over 5 to 10%, well over that. I'm not even doing the math correctly, just giving you an example, 5 to 10% on $200 per day, right? Which is a phenomenal amount of money. You're making more than 10, $20 a day. Take that money out. Take that 20, but you're only risking $200. Boom, take that $20 out, take that $50 out that you made and plug that back into your safer allocations, right? Plug that back into your medium risk plays, plug that back into your safer risk plays. So that way you're preserving that capital. Okay. So you guys have access to this again, and this is just the benefit of being involved in this community, having these conversations, reading through these documents, so that way we can mature as investors and we're not just sitting there trying to play the Deegan plays and high risk plays all the time. We can mature, we can understand that this is not a get rich quick scheme. This is not trading. This is a smart strategic strategy in which we're going to have to generate over a prolonged period of time to see consistent results. Okay. And so I'm just in an attempt to show you guys how I've become a six-figure entrepreneur and investor and trader and plan on becoming a multiple seven-figure investor and trader. And I'm going to try to lead you guys in every step of the way with all the information that I know possible. Okay. So you guys have access to this, utilize it to your advantage, build a strategy around some of these things and some of the things that I mentioned, and let's truck on. Okay. So next question was, about the how to find a good AMM with good returns. So I created this checklist for you guys. I just dropped this in the chat, the educational section this morning in the uni section. You guys have it right here. Go off of it. It's very strategic. All right. So we're going to walk through this process with you guys. And you can do this across any platform, across any DEX, across any liquidity pair. So when entering into a liquidity pool, here are some key factors to consider. Number one, you want to be choosing the right platform, selecting a reputable and secure DEX or decentralized exchange or DeFi platform that supports liquidity pools. And I gave you guys some examples, but ideally you want to pick a DEX with a high and a healthy TVL. The healthier the TVL, the less likely your investment is to get rug pulled or, bug smart contract or any of the things that could potentially happen negatively in DeFi. You can go onto DeFi Llama. Again, this is going to be one of the tools that we utilize here in the community. The vast majority of our investing and trading career in DeFi. And you're going to go down here to categories. And you're going to see the subsection of categories of all the opportunities that you can partake in DeFi. You have liquidity staking platforms. You have lending platforms. You have bridging platforms. You have DEXs, restaking, liquid staking, so on and so forth. All these platforms. Okay. Well, in each one, and so for the sake of this example, we're going to stick to DEXs. You can see that there are 1,310 different DEXs with a total value locked of $21 billion, right? So we're going to click that open. And when you're going in to pick a DEX, you don't want to be scrolling all the way down to the bottom, picking some of these DEXs that have no total value locked, that have no anything on them, or even these ones that have barely any money but might look appetizing in the sense of high APRs that they might be offering, you want to stick to the top of the list where you can clearly see healthy TVL. For example, Uniswap has $5.52 billion locked in total value. Aerodrome has $680 million in total value locked. I believe that was a milestone that they just announced on their Twitter profile. Radium for the Solana ecosystem, almost $1 billion in total value locked. So Radium might be a good platform, right? So on and so forth. Orca is another good one. You got Osmosis, Velodrome, right? Ideally, we want to see more, in my personal opinion, more than $50 million in total value locked on a DEX. Anything below $50 million, so as you scroll down, right, the cutoff range for me is right about here. Anything below $50 million, you're starting to play more high risk, right? You can still dabble in them. You can still take a look, right? But again, just understand that the lower the TVL, the more risk you are taking on. All right. You got Salsa Swap here at 104 million, so on and so forth. Okay. So you guys can go through, click these DEXs, look at the opportunities on them, look at the pools that they offer, and so on and so forth. So that's checklist number one. High TVL in the DEX that you choose, choosing the right platform. Now you can also go into each DEX, by the way. You can scroll down to their docs page, and in their documents page, most of them you should be choosing a DEX that has this information. They have audit information. So you can go in and you can look at if the DEXs are audited. You want to be on a DEX that is audited or that is transparent about their audits. That's another thing to mitigate risk when you're choosing a liquidity pool. Okay. Then you want to evaluate before you enter into a pool the asset pair. So for me personally, I'm heavy in Aerodrome and Velodrome pairs right now because I personally believe in Optimism chain and the base chain. I think that they're going to be immaculate in the future via the things, the mission statement, the goals that they're attempting to achieve, and what they have achieved this year and last year so far. And so you want to do careful research for the tokens that you plan on contributing to each pool. Do they have long-term potential? What is the utility surrounding them? Are they going to survive after regulations? So on and so forth, right? You guys catch that drift. So the overall project and the fundamentals, again, you don't just want to be going and getting the meme coins because we know most likely we're going to see a purge, and Hello Kitty meme coin probably isn't going to be around 2-3 years from now, right? So you're not going to really want to be in that pool long term. So just evaluate the assets in which you're providing liquidity for. I like Velodrome and Aerodrome because you get paid out in Aero and Velo emissions, and that concentrates to Velo and Aerodrome token. Those are two tokens that I could see myself holding long term under the bias that I feel like Aerodrome and Velodrome are going to be a much higher price in the future, right? For example, Salsa Swap, you get paid out in sauce, right? You get paid out in HBAR. I have a firm belief that the Hedera network in the future is going to be something that scales. So I wouldn't mind getting paid out in sauce, getting paid out in HBAR, whatever the case may be, right? So when you're choosing the DEX, make sure that you're looking at the valuation of the asset in which you're being paid out in, or the asset in which you're providing liquidity for. All right. Then we have the assess the liquidity depth. All right. So this actually gets into, so we talked about the liquidity depth of the actual DEX itself, right? So on the DEX itself, we want to see a good, healthy TVL. But then when you actually get into the DEX itself, so let's just go look at Orca for an example, okay? And you're looking to get into a liquidity pool, you want the actual depth of liquidity in the pool that you're looking to get into to be relatively healthy. Now, for me personally, my criteria is at least $500,000. The lowest I will go is 250,000. So half of that. But ideally, for the pools that I'm looking to get in, I would like to personally see the TVL above 500,000, right? So what does this mean? And I'll show you guys an example. A healthy total value locked above 500,000 in a liquidity pool is generally considered a positive sign for a few key reasons. High liquidity. A TVL above 500,000 indicates that there is a significant amount of capital that has been deposited into the liquidity pool by liquidity providers. And we know that liquidity providers allow what? Trading activity to happen. More trading activity, the more liquidity provided for said ecosystem or for said pair, the better off it is, the more that it grows, right? User confidence, it indicates a high user confidence. Just like in forex, right? You guys know that I'm a trader and that we talk about this. If there's demand for the Great British Pound due to upbeat or uplifting fundamental data from the UK front, then what does that mean? There's an increased investor appetite for the Great British Pound. Well, it's the same thing in total value locked in the DeFi space. If there's a high TVL, that shows investor demand and investor confidence in said assets, right? Then this also increases your revenue potential because liquidity pools with higher TVLs typically generate more trading fees. Remember that as a liquidity provider, we make our money by people trading these assets, and we get a portion of the fee for providing liquidity for them to be able to make and place these trades, whether they be buy or sell. So we don't give a fuck as long as they're as long as they're placing trades, we get paid, right? And then the protocol health. A consistently high TVL is often seen as an indicator of a healthy and well-adopted protocol. Okay. So if we just go take a look, for example, on Orca, for some odd reason, this DEX is always constantly dragging on, always has to load. So maybe we'll just go use Turbo's Finance just as an overall example, because this is a pretty beginner-friendly DEX in my personal opinion. But this, again, same metrics across the board. Doesn't matter if you're on Trader Joe, Osmosis, Uniswap, PancakeSwap, freaking Salsa Swap. All these metrics remain the same. Okay. So when I'm talking about the liquidity in the pool, you can see here the liquidity in this pool, Spam Soy, is only $28,000 as of time of recording this video. Whereas you go look at the Soy USDC pool, there's $4.9 million in total value locked. That's TVL in this pool. This pool is a lot healthier, clearly, than this pool here, right? I could be sitting here in the Spam Soy pool with the total value locked in this pool. I got $28,000 right now I could put into this pool. And if I was that person completely pulling all of my liquidity out of this pool, this whole entire pool would collapse. Why would you want to be in this, right? Okay. You want to be in something healthy, in healthy ranges. So moderately, anything above 500,000 in my personal opinion shows more stability. The lower, again, higher risk. Higher, less risk. Still risk, but less risk. Okay. And you can scroll down and you can kind of just go through and see the difference. So for example, here, Soy USDT, you might come in and be like, oh, 75% APR, great. Soy up against a stable coin. I'm going to get in. Wrong. Why? Look at the liquidity. $23,000 in this pool. That's a red flag. Okay. You don't want to be in that. Let's go see if we can find a different USDT pool that's healthy. Maybe not. Okay, but you get the drift. You go look at this liquidity pool, USDT, USDC, and you have $14.2 million locked. Albeit, yes, it's a lower APR, but the liquidity, the total value locked, is healthy. And so you want to double check this before you jump into a pool. Don't just jump into a pool because it gives you high APR. For example, let's look at this one, Turbos USDC. APR 178%. Wow. Oh my gosh. Let me get in. No. Only $136,000 in liquidity. I got that too. I could be the one person in this liquidity pool right now with this total value locked. And if I decide to sell my entire position, y'all are all screwed. Right? So you want something with a higher TVL. Hope that and again, each liquidity pool on each different DEX, you have the ability to check this information. So make sure that you're checking it. All right. Trading volume. This is the next big thing. You want to look for asset pairs with high trading volume. There's a couple different reasons. But overall, this ensures sufficient demand for the pair and allows you to earn more trading fees. That's the predominant reason, because we, as liquidity providers, earn trading fees. With that being said, if there is no trading volume in said pool or against said pairs, we're not going to be earning anything, right? The APR is going to throttle down because the trading volume throttled down. So we want to look for high liquidity and trading volume. which is a substantial 24-hour trading volume indicating that the liquidity pool has ample liquidity, making it easier to execute large trades without causing significant slippage or price impact. It also signifies an active market. It signifies attractiveness for liquidity providers because we make money by, again, accumulating fees off of people trading these assets. And so for us, we want to see a higher trading volume, preferably the trading volume exceeding or coming close to the total value locked in the pool. As an example, again, just looking at soy, you can see that the total value locked in the pool is 4.9 million, but the trading volume exceeds that at 6.2 million. This is a really healthy pool. This shows that people are actively locked in the pool and are actively trading it on a 24-hour volume basis, right? Whereas if you go look at this pool, the liquidity locked in the pool meets our requirements, right? 671,000 is above 500,000. So the liquidity locked in the pool meets our check mark list. But then if you go look at the 24-hour trading volume, there's only $91,000 traded on this pair. That's a no-go, right? We want the 24-hour trading volume somewhat moderately close or higher than the liquidity locked in the pool. So this would be a red flag. And again, it's the same across the board. For example, here, you can see, I don't know what this is, HA soy, up against soy. There's $4.6 million in the pool, right? Locked in the total value. But then look at the trading fees, 24-hour trading volume. Ain't nobody trading this. Nobody's trading this, 15 grand. That's a red flag, right? So make sure that you're just checking these things, double checking. And this will mitigate, again, a lot of the risk that you're going to take in look at this shit. Oh my gosh, 69,000% APR. Holy shit. Crazy, crazy, crazy. Anyways, okay, this will mitigate a lot of the risk that you're going to experience in DeFi, this checklist. Okay, so we went over trading volume. All right. Then we want to review pool fees. Remember that we get paid as liquidity providers off of fees. So ideally, looking at, again, the pool fees, we want something with a healthy fee tier. Anything 0.02%, like that's kind of pushing it. So for example, like 0.05%, you can see here, compared to a 0.3% is a significant change, right? That's a whole decimal point difference in the amount of money that you're going to be making. This is the percentage of fees that we're getting paid every single time somebody places a trade based off of this APR. So you want the fee tier to be relatively healthy. You don't want to be jumping into a pool that offers 1,000% APR, has healthy liquidity, has healthy trading for 24-hour trading volume, but has a 0.003% fee tier. How much sense does that make? None, because you're not earning any fees at that point, right? So you want something with a relatively healthy fee tier, okay? Preferably 0.1% or higher, okay? Correlated assets. All right. So I went over this again to mitigate risk. You can go to DeFi Llama and opt in to provide liquidity for pairs that are heavily correlated, that go up and down together. This mitigates impermanent loss. And this allows you to not sweat or freak out about your ranges. And it's a lot easier to concentrate your liquidity on correlated pairs. Okay. I wrote some examples, stablecoin pairs, ETH-matic, Bitcoin, Ethereum, so on and so forth. And again, you guys can use the tool, DeFi Llama, the new tool, correlated pairs. And before you get into a pool, just double check, look at the correlation. Anything above 50% is preferred. The closer to 100, the better. Okay, and remember, you just go to DeFi Llama, you scroll down all the way to the bottom, and you can see the correlation section, and you can dabble around, add different assets, look at the different 7-day, monthly, yearly correlation. Okay. Then we have, obviously, of course, considering risk management, understanding smart contract risks, and then understanding impermanent loss, which we have documents, and we're going to be pumping out videos on each of these things. So if you guys don't understand what impermanent loss is in detail, again, we're going to cover this. We're going to talk about how to mitigate against it, so on and so forth. All right, so hopefully this checklist answered some of the questions that were drafted up today in the DeFi chat. Okay. Giving you guys my personal, risk parameter and risk tolerance and risk assessment. Make sure that you're doing your own. Make sure that before you jump into a pool, please utilize this checklist criteria. Don't just be the person in this community that gets scammed because you saw high APRs and you took the freaking bait and you get rug pulled. Remember, this is not a get rich quick scheme. I would like to see everybody here succeed long term in a year, 2 years, 3 years from now. If you think about it,